In this video, we will introduce cash-to-cash cycle time. Cash-to-cash cycle time is an important measure in ERP. It helps determine the amount of capital that will be needed to operate a business. In English, cash-to-cash cycle time measures the time it takes from the payment due until the time the payments are received. So based on the definitions, basically the cash-to-cash cycle time can be calculated based on the following formulations. And we want to find the sum of the inventory days of supply plus the day of the sale outstanding, then subtract by the average payment period for materials. Let's see how it works. Usually this will be a typical cycle. First, the item will be produced, then the payment will be due. You need to pay your supplier. Then the item will be sold. After that, you will receive the payment from the buyer. So from the time where the item is sold until you receive the payment, that's what we call the day of sales outstanding. And from the time when the item is produced until the time item is sold, this is called the inventory days of supply or the inventory days of inventory. Okay? And from the time when the item is produced until the time the payment is due, this is called the average payment period for materials. So when we are trying to calculate the cash-to-cash cycle time, we want to find the distance between the payment due until the payment received. And if we want to calculate the length of that, we want to find the sum of the red line plus the blue line subtract by this yellow line. That's how we get these formulations. So let's see how we can calculate the day sale outstanding. Okay. Day sales outstanding is a measure of the average number of days that a company takes to collect the revenue after the sale has been made. And it is also called the average day of account receivable. That's the time it takes for you to receive the money from the buyer. So the first step you want to do is to calculate the average daily sale. And the formulation is you want to find out the sales over time divided by the number of days of sale. Okay. Once you figure that out, we want to calculate the day sale outstanding, ARD. Then you just find out what will be the total account receivable divided by the average daily sales. That will give you the answers. For example, suppose that the sales over the last 30 days is 1,200,000 and the account receivable in the end of the month will be 200,000. Then the first step is to calculate the daily sale. The daily sale will be the sale over time, which is 1.2 million, divided by 30 days. Then the answer will be 40,000. Then the day sales outstanding will be the account receivable, which is 200,000, divided by 40,000. And the answer is 5 days. Okay. And the second terms we want to calculate is the average days of supply or average day of inventories. So this is the average number of days the company holds its inventory before everything got sold. And the ratio measures the number of days funds are tied up to the inventory. Okay. And the first step we want to do is to calculate average daily cost of sales. And in order to do that, we first want to use the average daily sale multiplied by the cost of sale in percent. Usually we'll say that the cost will be 50% of your sale or something like that. So we can multiply the percentage to figure out the cost. Then the average day of inventory will be the current value of the total inventory divided by the average daily cost of sale, and that will give you the answers. For example, if the average daily sale is 40,000 and the total inventory value will be 400,000 and the cost of sale will be 60%, then the first thing we want to do will be to use the daily sales, 40,000 multiplied by 60%. That will give you the average daily cost of sale. Then we use the total inventory value, 400,000 divided by 24,000. That's the average daily cost of sale. The answer will be the average days of inventory. The last term is the days payable outstanding. This is the time it takes the company to pay its creditor. And the formulation is as follows. We want to use account payable divided by the average daily cost. Okay. And And for example, if the account payable will be 120,000 and the daily cost of sale will be 24,000, we simply use that to get the answers. Then we can calculate the cash-to-cash cycle time. And again, the cash-to-cash cycle time will be equal to the inventory days of supply plus the days of sales outstanding subtracted by the average payment period for material. So in this case, we have 16.7 plus 5 subtracted by 5, and the answer will be 16.7 days. So let's take a look for the example to see if we can solve the problem. Suppose that the sales over the last 30 days will be 2 million. And the account receivable in the end of the month will be 200,000. And the inventory value at the end of the month will be 500,000. Cost of sale will be 70%. Account payable in the end of the month will be 150,000. We want to calculate the cash-to-cash cycle time. So to do that, the first thing we want to find is the average daily sales, SD. And we know this is equal to 2 million. Divide by 30 days. That should be 666.67. The days sales outstanding, ARD, will be the account receivable divided by the average daily sale. So account receivable will be 200,000, yes, divide by 666.67. The answer will be equal to 3, so that's 3 days. The average days of account payable will be the account payable divided by the average daily cost of sale. We don't know the cost yet, so let's try to work on the cost first. The average daily cost of sale will be the average daily sale multiplied by the percentage. We know the average daily sale will be 666.67, and the percentage will be 70%. So it will be 46666.67. Okay. And now we can go back to find out the average day of account payable. And we know the account payable will be here, 150,000 divided by the daily cost of sale, 46666.67. So that will be roughly equal to 3.21 days. Similarly, the days of inventory will be the total inventory value. The total inventory value will be 500K divided by the cost. Again, the cost will be 46666.67. So we know it will be roughly equal to 10.71 days. So if we want to calculate the cash-to-cash cycle time, we know that will be equal to ID plus ARD subtracted by APD. So that will be 10.71 plus 3 minus 3.21. So the answer will be 10.5. And let's try to work on a different example to see if we know how to do it. So again, the first thing we want to calculate will be the average daily sale. The average daily sale will be the sales over time divided by the total days. So we have 2,500,000. We assume there are 30 days, so divide by 30. The answer will be 83,333. Okay. Then we want to calculate the days sales outstanding. So we want to find out how will be the account receivable. In this case, it will be 300,000. Divide by 833.33. That will be equal to 3.6 days. Then we can calculate the average daily cost of sale. That will be 50%. So 83,000 times 50%. This will be roughly equal to 41666.67. So the average day of account payable will be the account payable divided by the cost. The account payable here will be 200,000 divided by 41666.67. That will be roughly equal to 4.79 days. Okay, similarly for the inventory, we have 400,000 divided by the cost. That will be roughly equal to 9.5 days. Okay, so now the cash to cash cycle time will be equal to 9.5 plus 3.6 minus 4.79, and it will be equal to 8.31. Let's try to look at another example. In this example, we actually will see something like this. There is no descriptions, but instead there are some notations. So in fact, this will be the example that you will see from the textbook. But again, you should be able to do a problem like this without any issues. So first we want to calculate SD, the daily sales. And SD is equal to S divided by D. So that will be 1. Okay, here 1 0. I think that's 10 millions, right? Divide by 30. So that will be 16666.67. Then we can calculate the account receivable, ARD. Account receivable will be AR divided by SD. So I have 750,000 divided by 16666.67. And that should be equal to 4.49 days. Then we can calculate the cost. The cost will be your SD multiplied by the percentage. In this case, it will be 60%. So this is roughly equal to 100,000. Then we can calculate the account payable, APD. That will be equal to AP divided by CD. Our AP will be 250,000 divided by CD. That will be 2.5 days. Okay, and the days of inventory ID will be equal to your inventory divided by CD. And inventory will be 1 million divided by CD, which is 100,000. So that will be 10 days. Then we know the cash to cash cycle time will be equal to ARD 4.49 plus ID 10 subtracted by 2.5, and it will be equal to 11.99. So there are several ways for you to keep the cash to cash cycle time long. For example, we can try to reduce the cost of sale, or we can try to increase the overall sales, or maybe we can try to reduce the inventory level a little bit. And so you need to think about what if we change a certain amount, how the cycle time will change. Okay, so as long as you will be able to keep the cost down, then your cash to cash cycle time will be better. Similarly, if you keep the revenue high, you can increase the cash, you can decrease the cash to cash cycle time as well. And so this one will help you try to figure out whether the cash-to-cash cycle time will increase or decrease. For example, if you take the advantage of early pay discount with the suppliers, then likely it depends, okay? First, your cost will be lower. So when the cost is lower, your cash-to-cash cycle time will be lower. However, if you pay early to your suppliers, it means that it takes longer time for you to receive the payment from the buyer. So the cash-to-cash cycle time might be higher. So you really need to check which one has a larger effect. So take a look at this slide to see if you will be able to analyze how the cash-to-cash cycle time will change. And I have a couple questions for you. What does it mean for a firm when the cash-to-cash cycle time is high? We know when the cash-to-cash cycle time is high, it means that it takes much longer time for you to receive the payment. So you need to pay your supplier first. Then you need to wait for a longer time until you receive the payment back. Which means if you want to operate your business, likely you need to get a higher credit from the bank. Otherwise, you cannot keep the cash flow well. And so it will take you more effort to operate the business. So the second question is that can the cash-to-cash cycle time be a negative number? The answer is yes. And when the cash-to-cash cycle time is a negative number, it means that likely you will receive the payment from your buyer first, then you pay your supplier later. So this is even better. It means that you have a tons of cash and you don't need to worry about borrowing the money from the bank. So it may be the good idea for you to operate that way. But in general, we want to keep the cash-to-cash cycle time low as possible. And for the assignment, please read the chapter 1 and 2 and remember to get a textbook. And the first quiz will cover chapters 1 and 2.